Tesla stock is down roughly 24% from its all-time high in December. On some intraday prints earlier this year, it was down 40%. And right now, somewhere in your feed, someone is screaming that this is the discount of the decade. Back up the truck, buy the dip. Tesla isn't a car company, they'll tell you. It's an AI company, a robotics company, an energy company. The market just doesn't get it yet. I want to show you, with actual arithmetic, why that argument is one of the most expensive misunderstandings in the market right now. Not because Tesla is a bad company. It isn't. Not because Elon Musk is going to fail. He might not. But because the 30% drawdown you're looking at isn't a sale. It's the market doing something very specific, very quietly and very mathematically. It's pulling a costume off. I call it the tech disguise. Picture a heavy, slow-moving factory worker boots, coveralls, the whole thing wearing a sleek, glowing VR headset. The headset is beautiful. It shows the sky. It makes you forget there are boots on the ground. And for a few years, the market priced this guy like he could fly. But when gravity shows up, and gravity in this business is called margin compression, the headset doesn't lift him. The boots win every time. That's the whole video. I'm going to come back to that image again and again with different numbers plugged in until by the end you can run this math yourself on any so-called tech-disguised company you see. Let me earn it. First, let me be honest about what this is not. This is not a video about Tesla being a scam. It isn't. This is not a video about Elon Musk being a fraud, or about electric vehicles being a bad idea, or about robo-taxes being vaporware. Tesla genuinely changed the auto industry. They forced every legacy manufacturer on Earth to take EVs seriously. Their supercharger network is real infrastructure. Their software updates over the air are something Toyota still can't really do. The Megapack business energy storage is a legitimately impressive, high-margin operation that grew its gross margin to nearly 40% last quarter. That's a serious business. I'm not here to mock any of that. I'm also going to concede the strongest version of the bull case up front, because if I don't, you shouldn't trust the rest. The bull case goes like this. Cars are just the cash cow that funds the real prize. Full self-driving subscriptions grew 51% year over year. Robotaxis are now doing unsupervised rides in Dallas and Houston. Optimus is in factories. If even one of those bets lands at scale, then today's price tag isn't expensive. It's a steal. That's a real argument. I'm not going to pretend it isn't. Here's what I am going to do. I'm going to show you what the market is currently being asked to pay for those maybes. And I'm going to show you the math that determines whether the thing under the costume can actually carry that weight. So let's build this from the ground up. At its core, every public company is just a machine that turns inputs into profits. You, as a shareholder, are buying a slice of those future profits. The price you pay for that slice divided by the profits the company actually earns is called the price-to-earnings ratio, the P/E. It's the rent you're paying for each dollar of profit the company is producing. A boring industrial company, a real car manufacturer like Ford, like Toyota, like General Motors, trades at a P/E of somewhere between 6 and 10. That means investors are willing to pay $6 to $10 for every dollar of annual profit. Why so low? Because making cars is brutal. It's capital intensive. The margins are thin. A recession can cut your profits in half. A union negotiation can do the same, so the market doesn't pay up. A real software company, the kind that writes code once and sells it 1,000,000 times, trades at a P/E of 30, 40, sometimes 100. Why so high? Because once the software exists, selling another copy costs almost nothing. Gross margins of 70 to 80% are normal. Revenue is recurring. The math is just better. Tesla, as I'm recording this, is trading at a P/E of well over 300. Read that again, slowly. Over 300. That is not a car company multiple. That is not even a normal software company multiple. That is a multiple that says, we believe this company is about to become something it currently is not. Now here's where it gets interesting. Let's actually look at what Tesla is right now in the most recent quarter on the books. Tesla's first quarter of 2026 produced about $22.4 billion in total revenue. Of that, $16.2 billion came from selling cars. Another $2.4 billion from energy generation and storage, and $3.7 billion from services and other, which includes supercharging, used cars, insurance, and yes, full self-driving subscriptions. Let me translate that. About 73% of Tesla's revenue right now in 2026 comes from metal on 4 wheels. Roughly 11% comes from selling batteries to utilities. The remaining 16%, services and software, is the part everyone wants to call the AI company. And even inside that bucket, most of it is the unglamorous work of fixing cars and reselling them. Sit with that for a second. 3 out of every $4 Tesla brings in the door come from being a car company. The headset is beautiful. The boots are still on the ground. Now, let me show you why margin compression, the gravity that pulls the headset down, is so brutal in this business. This is the heart of the whole video, so I'm going to walk it slowly. Imagine Tesla sells a car for $50,000. Imagine it costs them $40,000 to build that car. The steel, the lithium, the labor, the factory overhead, all of it. The difference, $10,000, is the gross profit on that car. 10 divided by 50 is 20%. That is the gross margin on that vehicle, 20%. Now the economy gets tough. Chinese competitors are undercutting Tesla in Europe. BYD is eating market share in Asia. The American EV tax credit expired. Inventory is piling up on lots. Tesla literally produced about 50,000 more vehicles than it delivered in one recent quarter. So what does Tesla do? What it has actually done repeatedly for the last 3 years, it cuts prices. Let's say it cuts the price of that $50,000 car by $5,000. That's a 10% price cut. Painful, but not catastrophic sounding, right? Here's where the math gets brutal. The car now sells for $45,000, but it still costs $40,000 to build. The steel didn't get cheaper. The lithium didn't get cheaper. The factory still has to be paid for. So the gross profit on that car has collapsed from $10,000 to $5,000. A 10% cut to the price wiped out 50% of the profit. Read that again slowly. A 10% price cut wiped out 50% of the gross profit on that vehicle. That is margin compression. That is the gravity. And in a low margin business, which is what a car company structurally is, that gravity is enormous. It is mathematically why car companies trade at P/E of 8, not 300. Now run the one number on it. If profits get cut in half and you want the P/E ratio to stay the same, the stock price has to get cut in half too. That's just arithmetic. If the market suddenly realizes that Tesla's earnings power is closer to a car company's than a software company's, the price doesn't drift down. It re-rates hard. That's what a 30% drawdown looks like. It isn't a discount. It's the market quietly taking the headset off. Let me give you the actual numbers Tesla reported, because this isn't hypothetical. In the most recent quarter, Tesla's overall gross margin was 21.1%. That's an improvement from a year ago, partly thanks to some one-time tariff benefits and a higher mix of services revenue. But here's the line that matters. Tesla's operating margin, the profit left after the cost of running the company, the R&D, the payroll, the lawyers, was 4.2%. 4.2. That is a margin profile that lives in the same neighborhood as a legacy automaker. Ford's operating margin runs in the low single digits. GM's runs in the low to mid single digits. The tech company producing the AI revolution is currently throwing off operating margins indistinguishable from the Detroit it was supposed to bury. And here's the catch the bulls don't bring up. Tesla is spending its way through this. The company guided to over $25 billion in capital expenditure for 2026. That is a staggering number. It's going into AI training compute, into a chip program called AI5, into the Cybercab, into Optimus, into new factories. The bull case for the stock requires every dollar of that spending to pay off, on schedule, in markets that currently exist mostly on slide decks. Now let me be honest, because I promised I would. Could it work? Yes. Could FSD become a recurring software subscription that millions of car owners pay for monthly at 80% margins forever? It could. Could the robotaxi business become a fleet of millions of autonomous vehicles generating high margin per mile revenue? It could. Could Optimus eventually replace categories of human labor? Possibly, someday. I'm not going to tell you those things are impossible. I don't know the future. Nobody does. Anyone who tells you they do is selling you something. What I can do is show you what would have to happen mathematically just to justify the price you're being asked to pay today, and that brings me to history. In 1999, there was a company called Cisco Systems. Cisco made the routers and switches that the internet was being built on. The story was airtight. The internet was real. It was going to change the world. And Cisco was, as the headlines put it, the backbone of the internet. By March of 2000, Cisco was briefly the most valuable company on earth, trading at a P/E of around 200. Investors weren't pricing it as a hardware company. They were pricing it as the inevitable winner of a permanent, generational shift. And they were right about the shift. The internet did change the world. Cisco did remain a huge, profitable, important company. None of the bullish story was wrong. But the stock crashed by over 80% in the bubble's unwinding. And here's the part the buy the dip crowd never finishes the sentence on. Cisco stock did not recover its all-time high for over 20 years. 2 decades. People who bought the dip in 2001 when Cisco was down 60% and looked like a screaming bargain were still underwater on that purchase in 2015. The company kept growing. The internet kept getting bigger. The narrative kept being right. The price had just been wrong. I want you to really hear what that means. You can be correct about the technology. You can be correct about the future. You can be correct about the company surviving and even thriving. And you can still lose in real terms for 20 years because you paid the wrong price for being right. That's what a PE of 300 is asking you to risk. Let me lower the bar as far as I honestly can. Forget making a fortune. Let's just ask what it would take for Tesla, at today's price, to match a boring S&P 500 index fund. The S&P has done about 10% a year on average over the long run. Just to tie that, just to match the index, Tesla's earnings would have to grow at roughly 20 to 30% a year, every year, for the next decade, while the P/E ratio compresses gracefully from over 300 down to something more normal every year. No misses, no recession-driven price cuts, no competitor from China that's a generation ahead on cost, no regulatory delay on robotaxi, no Optimus disappointment. 10 years of nearly flawless execution just to match the index fund you could have bought with one click and ignored. That is what the math actually demands, not for a home run, for a tie. And listen, I want to be straight with you. I'm not telling you Tesla goes to zero. I don't believe that. I'm not telling you the stock can't bounce next month or next year or rip 30% higher on an Optimus demo that catches everyone's imagination. It absolutely can. Hype-driven stocks do hype-driven things. The point isn't to predict the next move. The point is to understand what you're actually being asked to pay for and what has to be true for that price to make sense. Here's the part the headlines get wrong. They will tell you a 30% crash is a sale. They will not tell you that the crash is the market doing the work of re-rating a company from a software multiple to something closer to a hardware one. They will show you the chart of the bounce in 2020 and tell you it always comes back. They will not show you the chart of Cisco from 2000 to 2020. They will not run the margin math on a 10% price cut. They will not mention that the operating margin of the AI company is the operating margin of a Detroit automaker. I'm not here to tell you what to do with your money. I'm telling you what the math says. And the math says this: the cost of being wrong about the tech disguise is not symmetric. If you're right and Tesla pivots to a software margin business, you make money. If you're wrong and it stays mostly a car company, you don't just lose a little. You can lose for a decade, like the Cisco shareholders did, while the company underneath you keeps existing, keeps shipping product, keeps being technically successful, and keeps being a terrible investment at the price you paid. There are two loud answers floating around your feed right now, and I want to reject both of them. The first is the cheerleader answer. This is the dip, back up the truck. You'll regret it forever if you don't. The second is the cynic's answer. It's all a fraud. The whole company is a house of cards. Short it to zero. Both of those are entertainment. Neither of them is math. The quiet third answer is the one I want to leave you with. Look at what the company actually earns. Look at where the revenue actually comes from. Look at the margin profile honestly. Decide for yourself what multiple that business deserves. And then ask whether the price in front of you reflects that reality, or whether you're being asked to pay for a future that may or may not arrive on the schedule the headline promises. The tech disguise is a costume. It's a beautiful one. It might even be partly real. Pieces of that AI future might genuinely be under there. But the moment gravity shows up in the form of a $5,000 price cut on a $50,000 car, the boots are what's left standing. And the market eventually prices the boots. That's the one number. Margin compression times revenue concentration. The smaller the margin and the bigger the share of revenue exposed to it, the harder gravity hits. Run that math on any company someone tries to sell you as a tech disguise play, and you'll save yourself a lot of money. If running the numbers before you make a move is the way you want to think about your money, subscribe. That's what this channel is for. We do the arithmetic out loud so you don't have to take anyone's word for it, mine included. Run it yourself, then decide. I'll see you in the next one.